During my internship, one of my main responsibilities included carrying out periodic research to provide timely updates on market activities and the overall private equity landscape. Well, it became my responsibility when the partner asked me what was happening in the markets, and I was stuttering like.
I promise, like, and even it's been a weird these past few months. And
after that embarrassing encounter, I decided to make it my responsibility to stay up to date with what was happening in the markets and update the team, as I noticed that people value the individual who had current information. This also applies in interviews, to be honest, because you really don't want to be that guy in a private equity interview whose questions lack depth and you're basically a distant memory to the interviewer once you walk out the door. Grasping key concepts and timely insights about the industry will make you stand out amongst other candidates, as it demonstrates your commercial awareness and ability to stay ahead of the curve. In this video, I'll be talking through key trends in private equity you must know about, how to integrate them into your conversations and interviews, and credible sources for private equity insights. But before we go any further, a trend that has recently been going around is smashing the like button for the YouTube algorithm, as it costs £0 and takes 0.001 seconds to do. And also, as you guys know, I'm the founder of Beyond Education, a platform dedicated to helping individuals access and navigate early career opportunities in the working world. So it's only right that I do these shameless promos in these videos from time to time. We recently launched a resource portal exclusive to the members of our website. The resource portal contains various different features, but one of the main things I wanted to highlight is the Career Suite, which is a repository of CVs, cover letters, and interview prep notes for actual industry professionals. So imagine if you wanted to access a CV that landed someone an interview at JP Morgan, for example. You can access this via the website as a member, and this is all free. Other features on the resource portal include an e-learning library, which has informative career-oriented videos, and then an industry insights page, which has detailed blogs from industry professionals. To access the website and become a member, just click the link in the description, and there's actually a limited amount of members that we can host on the website at a given time, so I would say just access it as soon as possible. But yeah, let's get into the video. GP-led secondaries are booming. So you might be thinking, Stephen, what the hell is GP-led secondaries? In fact, Stephen, what the hell is a GP and why are they being led to this thing called secondaries? All valid questions which I'll attempt to answer in a jargon-free way before delving into why this is a trend you must know about if you're interested in private equity. Now, GP is simply a short way of saying general partner. Most private equity funds are structured in an LP-GP structure. So LP stands for limited partner, aka investors, giving their money to the general partner, aka the private equity firm or fund, who has discretion on where and to a certain extent how the investor's money should be invested. Are you still with me? Okay, good. Now, in private equity, if a fund invests in a business where the founders are the owners of the said business, this is a primary transaction, and there's usually a holding period of about 3 to 5 years before they decide to sell it to another fund or IPO it to get a return on their investment. However, some funds are increasingly going down the secondaries route. So rather than selling or IPOing, the fund, i.e. the general partner, would work with existing investors to sell or transfer the asset, aka the business it owns, to a newly formed fund with capital from new investors as well as existing investors who desire to continue to hold the asset or have exposure to the company, while allowing other investors to cash out if they wish to do so. They are called secondary transactions because they involve trading interest in existing funds and assets. Now, I hope that makes sense, and if it doesn't, I'm really sorry, but that's as jargon-free as it goes. Now, the growth of GP-led deals has significantly outpaced LP-led secondaries over the past 5 years, with deal volumes roughly equal for both parts of the market in 2021, compared with 2016, when GP-led deals represented less than 1/3 of the market. So essentially, more funds are holding on to their assets for longer by flipping them into another fund as a secondary transaction. And you're probably thinking, why would they want to hold on to their assets for longer? Why don't they just sell it and cash out? Well, if they believe that there's value to be derived from that asset still, they don't want to sell it prematurely and lose out. So they hold on to it for longer, create more value, and then ultimately exit at a higher price at a later date versus selling to another firm or IPOing on a stock exchange, if that makes sense. The best way to integrate this insight in a private equity interview is by identifying a portfolio company within that fund that you're interviewing for that has been held for about 3 to 5 years, and then ask questions around possible exit strategies, sprinkling some of your newly acquired GP-led secondaries knowledge into the interview. Everyone is fundraising. According to confirmed data and projections from Nasdaq Investments, 133 buyout funds will be in the market fundraising for a first close between Q1 and Q4 2022. 133 funds, that's insane, but get this. In total, these new buyout funds are seeking to raise 340 billion from investors, a 47.4% increase from the total sought by funds with first closes in 2021. The percentage of funds targeting fund sizes of over 1.5 billion has grown 17%. The fundraising landscape has left emerging markets struggling to raise capital due to established managers coming back to markets faster. Basically, every single Tom, Dick and Harry is asking investors for money, and it's increasingly difficult for new funds to raise capital due to established funds all coming back to the market at the same time. So your Thoma Bravos, EQTs, BlackRocks, KKR, Hellman and Friedman, and the list goes on, are all raising capital at the same time. And they're obviously going to be favored than the small mid-market PE fund who wants to raise a couple of million to prove a track record. Now, I'm not gonna lie, incorporating this insight into an interview can be very risky, as some firms are sensitive about struggling to raise capital, especially small mid-market funds. But nonetheless, if you're feeling ballsy, you can ask something along the lines of, how's your firm navigating a crowded fundraising market versus the priority on the execution of deals? Now, you would either receive an extensive tangential answer or a snark response, so ask at your own risk. However, this is a trend worth knowing about if you're interested in private equity, as it demonstrates your awareness of the investor allocation landscape. Everyone loves a bit of ESG. Investors are increasingly concerned about ESG considerations when it comes to allocating capital to private equity funds. In case you've been living under a rock, ESG stands for environmental, social, and governance, factors that investors are increasingly paying attention to these days when they're allocating capital. There's growing evidence that when investors embed ESG considerations into their strategies, they achieve superior valuations and a host of positive outcomes. Arguably. According to Bain & Company's private equity report, 93% of investors would walk away from an investment opportunity if it posed an ESG concern. In the past, ESG efforts were primarily viewed as good PR to receive favorable press, please socially conscious employees, and mitigate risk. But today, ESG considerations are increasingly viewed through the lens of value creation and is of great importance in the industry. A great way to demonstrate your consciousness on ESG practices would be to talk about the fund's ESG policy and ask about any developments they're considering from an ESG perspective. Alright, other trends that are worth noting include valuation adjustments. So rising inflation has led to increased interest rates from central banks, which has then led to the present value of companies' future earnings decreasing, knocking down valuations. Basically, companies are worth less. So the funds are adjusting their valuations in line with public markets unless they were conservative when underwriting their deals, basically. So if they were underwriting their deals at cheaper valuations, then this wouldn't really be a thing. There's also been an industry shift of private market access to retail investors. So a lot of high net worth investors are increasingly interested in allocating capital towards private equity. And lastly, healthcare and disruptive tech are seen as strong performance verticals with a lot of opportunity to be capitalized on. And yeah, man, there we have it, peeps. Those are the key trends to know about in private equity this year. Now, obviously, guys, there are a lot more private equity trends out there. However, these are some of the recurring themes everyone seems to talk about on my internship. So I believe if you sprinkle some of these into conversations in an interview, you're going to leave a good impression. Also, a quick honorable shout out to all the sources that made this video possible and will be linked in the description below if I can be bothered to dig them out. But we have the Hamilton Lane Market Overview, the Secondaries Investors website, Pantheon Ukraine Conflict Update Report, Pantheon Private Markets Outlook, Bain & Company Private Equity Report, Reuters Countdown to Launch, Lazard Secondary Report, the Private Equity International website, and I believe the Nasdaq Investment Report. Now guys, it's with deep regret to inform you that this might be my last YouTube video I make covering private equity, because as of Friday 29th of April, I officially quit my private equity internship to become a full-time YouTuber. No, but seriously, I did quit my internship though. However, more on that in upcoming videos, so stay tuned. And yeah, man, anyways, if you like this video, please like, comment, share, and subscribe. Turn on post notifications so you don't miss a thing. And I'll catch you guys in the next one. Deuces.